From the start of 2023 to 31 May this year, we saw a rally in anything related to generative artificial intelligence. Over those 5 months, the S&P 500 rallied 8.5%. Of this, the 7 largest stocks in the S&P contributed 10%, whilst the other 493 companies actually detracted 1.5%. However, since June 1 this year, the rally has broadened, coinciding with the debt ceiling debate resolution, so all areas of the US market rallied from June to July. Some say that this broadening rally is a new bull market. We disagree. The US equity market in particular, but also other equity markets such as Australia, are being buoyed by positive GDP growth, resilient employment, and still high consumer confidence. We think that there may be too much good priced in. Contrast the current exuberance, if you will, to mid-2022, when the various central banks' rate hiking cycles first commenced, and everyone began dumping growth, or what we would call long-duration stocks, fearing the impact of rising rates and what they would do to discounted cash flow valuations. Yet now, interest rates actually are much higher, but the narrative has flipped 180 degrees, and investors are now agnostic to these very same risks. Interest rate hikes take time for their effect to be fully felt. GDP and inflation and employment, these are all coincident to lagging indicators, not leading indicators. There is plenty of evidence that rate hikes are starting to affect the economy. Yield curves remain inverted, gross domestic income is negative, manufacturing PMIs are in contraction, non-farm payrolls, retail sales, new home sales, housing starts, these are all lower than forecast. Productivity is negative year on year. And we've started to see earnings downgrades as well. So there are many indicators outside the basic GDP and inflation data pointing to troubles that may lie ahead. But we don't believe this is priced into equity markets presently. In Australia, we are also seeing fundamentals deteriorate, with various PMIs in contraction, our yield curve also mildly inverted, the fixed rate cliff of higher mortgage rates for consumers is beginning from September, and China's reopening has failed to live up to expectations. With Europe already technically in recession and leading economic indicators across the G8 countries suggesting a high chance of slowdown or recession, plus a higher for longer rates mindset from central banks, we think the cost of rate hikes is being underappreciated in equity markets, particularly the US. The Fed is unlikely to start cutting rates unless either the economy or the equity market breaks. Otherwise, why would they? Yet markets are factoring in meaningful rate cuts in 2024. We believe this would only occur if the economy took a nosedive or if equity markets came under significant stress. So whilst we recognise the headline arguments for the equity market rally, we believe the concurrent assumptions that GDP will remain strong and that inflation will come under control and therefore lead to the Fed cutting rates is simply unrealistic. The economy is likely more fragile than the market thinks, and if it's not, then the Fed has no reason to cut rates while the economy and employment remain strong.